Welcome to Weekend Parchala. In today's topic we will try to understand about mutual fund. What is mutual fund? A mutual fund is an investment vehicle that collects money from numerous investors to purchase a diversified portfolio of securities such as stocks, bonds, and other instruments. Who manages mutual fund? Mutual funds are managed by professional fund managers working for asset management companies, AMCs. How mutual funds work? An AMC establishes a fund with specific investment goals. Pooling funds, investors purchase units at the current net asset value, NAV, combining their funds. Portfolio management, fund managers invest the pooled money according to the fund's stated objectives. Returns are generated from the underlying securities and distributed to investors. Liquidity, investors can generally buy or sell units on any business day at the closing NAV. Types of mutual funds. Equity funds, invests in stocks, long-term growth, higher risk and potential returns. Debt funds, invests in fixed income securities, bonds, stable returns, lower risk, regular income. Hybrid funds, invests in mix of equities and debt. Balanced risk return profile. Index funds, replicate a market index. Passive management, lower costs. Liquid funds, short-term debt instruments, high liquidity, suitable for short-term goals. Tax-saving funds, invests in equities, ELSS, tax deductions under Section 80C, with benefits of investing in mutual funds. Diversification, mutual funds reduce risk by investing in a variety of assets. Professional management, expert fund managers make investment decisions. Affordability, investing can begin with small amounts. Liquidity, most open-ended funds allow for easy buying and selling of units. Transparency, funds are required to regularly disclose their holdings and performance, NAV. Tax benefits, some funds, like ELSS, offer tax deductions. Convenience, investing is possible online or offline, with options like SIPs for regular contributions. Points to remember while investing in mutual funds. Fees and expenses, expense ratio, mutual funds charge an annual fee, expense ratio, to cover management, administrative, and marketing costs. While seemingly small, these fees can eat into your returns over the long term, especially if the fund's performance is mediocre. Loads, some funds charge entry loads, now largely discontinued in India for direct investments, or exit loads, charged when you redeem units before a specified period. These can reduce your net investment or redemption value. Other charges, there might be other -c, e.g., avoiding certain industries. Lack of control and customization. As an investor, you have no direct say in which specific stocks or bonds are bought or sold. The fund manager makes all the investment decisions. This lack of control means the portfolio may not perfectly align with your individual preferences or ethical considerations, e.g., avoiding certain industries. No guaranteed returns. Mutual funds are subject to market risks. Their value can fluctuate significantly based on market conditions, economic factors, and the performance of the underlying securities. There is no guarantee of principal protection or specific returns, and you could lose money, especially with equity-oriented funds. Tax implications. 1. Capital gains. When you redeem your units, you may incur capital gains taxes, short-term capital gains, STCG, or long-term capital gains, LTCG, which vary based on the fund type, equity versus debt, and holding period. Dividend distribution tax, DDT. While historically relevant, current tax rules have changed how dividends are taxed, placing the burden on the investor's tax slab rather than a DDT at the fund house level. Internal trading. Even if you don't redeem your units, the fund manager's internal buying and selling of securities can trigger capital gains within the fund, which might be passed on to investors, potentially affecting the NAV and your tax liability. Over-diversification, diluted returns. While diversification is generally an advantage, excessive diversification can sometimes dilute returns. A fund with too many holdings might not capture the full upside of its best-performing assets, leading to average returns. For a highly concentrated portfolio, the returns are diluted across many holdings, potentially leading to returns closer to the market benchmark, but after deducting the expense ratio. Market timing is still relevant, to some extent. While SIPs help average out investment costs over time, lump sum investments can still be affected by market timing. Even with SIPs, if a significant market downturn occurs close to your redemption date, your returns could be negatively impacted. Investments types in mutual fund. Lump sum investment involves investing a substantial sum of money at once. Units are allotted based on the net asset value, NAV, on the investment day. Suitable for investors with a large amount of capital available for immediate investment. Used in closed-ended funds which accept investments only during the new fund offer, NFO, period. Systematic investment plan, SIP, involves investing a fixed amount at regular intervals, e.g., weekly, monthly, quarterly, in an open-ended fund. Units are allotted based on the NAV on each investment date. Benefits from rupee cost averaging, which helps mitigate the impact of market volatility by averaging out the cost of units over time. Promotes disciplined investing and is suitable for long-term wealth creation. Flexible options like top-up SIP, flexible SIP, and perpetual SIP are available. Systematic transfer plan, STP, allows periodic transfer of a specific amount of money from one mutual fund scheme to another within the same fund house. Typically used to move funds from a lower risk scheme, e.g., debt fund, to a higher risk, growth-oriented scheme, e.g., equity fund. Aims to optimize returns while managing risk through strategies like rupee cost averaging and risk mitigation. Types include fixed STP, flexible STP, capital appreciation STP, and trigger-based STP. Redemptions in mutual funds. Redemption is the process of withdrawing your invested money from a mutual fund scheme. You can redeem units either partially or fully. Partial withdrawal, redeeming a portion of the total investment while keeping the remaining amount invested. Useful when you need funds for specific purposes without liquidating your entire investment. Full withdrawal, complete redemption, liquidating the entire investment in a mutual fund scheme. Done when all funds are needed, or the investor wishes to exit the investment entirely. Systematic withdrawal plan, SWP, allows investors to withdraw a fixed amount from their mutual fund investment at regular intervals, monthly, quarterly, or annually. Provides a steady stream of income while the remaining investment continues to grow. Units are redeemed periodically based on the chosen withdrawal amount and the prevailing NAV. Suitable for retirees, freelancers, or those seeking a predictable cash flow from their existing corpus.
For any requirements on the financial planning and products, visit us at ray3capital.my. Canva site.